Good morning all, and welcome to our year-end tax planning presentation. For those of you who don't know me, my name's Alistair Wilson and I'm one of the tax partners at MHA Tait Walker. For those of you who have been on these types of presentations before, we will be running through the slides and Sam, our marketing team, will be in control of the slides. Just in terms of a bit of housekeeping, we will be doing a Q&A session at the end of the webinar. There is a chat function in the webinar itself, and so we will be able to take any questions. But what we would propose to do would be to answer the questions at the end of the webinar once we've seen the ones that have come through. In view of the nature of the content, the questions could be something that is either generic, and in which case we will endeavour to answer it. If it's something which looks like it's quite personal to the individual who is asking the question, what we may do is suggest that we take it offline and then we will answer it individually, one-to-one with the person. Just in terms of the presentation today, so on the presentation today we have a collection, or I'm joined by a number of individuals from both our tax team and also our wealth management team. So we've got Omar Din and Mark Parkinson from our wealth management team. We also have Laura Dixon and Claire Smales from our tax team. This presentation, it's deliberately set up as one which is a combination of both tax and wealth management. This time of year, we always produce a guide which is a combination of tax and wealth management issues and pointers, housekeeping ideas that people should be thinking about as we head towards the end of the financial year. This year, I would say it's probably more relevant than in a typical year, because we're expecting a lot of activity to be required by people who are either managing their way through the pandemic, or alternatively, just as we head towards the budget, we are expecting a significant amount of changes over the next few years as we get to the stage of the government having to pay for the measures. In terms of the slides, so Sam, are we able to move on to what would be the background slide? Just in terms of the background, so at the moment, the government are estimating there are 125 billion of extra amounts that have been saved by households in the UK. Now, within that, what is happening, as many people will be aware, in some instances, people are actually able to save money at the moment because they're unable to get out and spend money that they typically would do. That's not universal. Obviously, there are households that are struggling, but equally, there are households that are in a position that they're lucky enough to be able to save at the moment. Unfortunately, however, the cost of the measures that the government have had to bring in to help us deal with the COVID pandemic, the cost of those measures is estimated to be about £400 billion. Now, even if the UK households were to spend the amount that they had saved, there clearly is a shortfall in terms of the cost that the government have borne so far compared to the amount of money that might come back into the economy. So there is clearly a gap to fill in terms of paying for all of the COVID pandemic measures. However, there is a general expectation that once recovery starts, it will be swift, but that recovery will only start once it's possible to do so. So as we head out of lockdown measures and into a more stable set of circumstances. Sam, if we can move on to the next slide. So that's the what might change. Well, we would say as we head towards the budget on the 3rd of March, we are expecting to see that the Chancellor will bring into play some measures to encourage spending. We're hoping that the Chancellor will bring in measures to encourage investment in jobs, investment in new facilities, etc., the types of measures that help us to grow as an economy. The Chancellor has, however, already said that he would intend to maintain what is known as the triple lock. And the triple lock is a pledge to not change income tax, national insurance and VAT rates upwards for 5 years. Now, that's a manifesto pledge that was made whenever the government were elected back at the end of 2019. Now, the difficulty with all of that is it limits what the government can do. Now, that doesn't mean that you can't have increases in things like income tax and national insurance and VAT because of changes in how rules are applied, but it does mean that there shouldn't be an upward change in terms of rates. So I guess one of the things, just in terms of the triple lock, what people should bear in mind is that that doesn't mean that the government can't curtail how some things work in terms of tax reliefs, but it does mean that those headline rates shouldn't change. But overall, that all then means, in terms of what latitude the government has in terms of increasing tax rates, we would expect that any focus in the budget will be on corporate tax, capital gains tax, and potentially pensions tax reliefs. But all of which we will find out on the 3rd of March. We haven't had a budget for quite some time because the Chancellor has not felt it to be appropriate to do so. And so this one, you should watch it more keenly than ever. And we will, of course, be doing a presentation on the 4th of March. Sam, if we can move on to the next slide then, just in terms of the timing of any changes. So, what governments have previously done in the past, and why this is relevant. Governments have in the past quite often announced tax changes or financial changes, but then have delayed the timing of introduction of those. This works quite well from a revenue raising perspective, because if an increase in taxes has been announced, but there is a delay in implementation of those changes, it encourages people to act ahead of the changes. So we're already seeing that in relation to, for example, capital gains tax. And because the government have been talking through what they might do in terms of changes in terms of capital gains tax, people have been looking at selling businesses, they've been looking at selling second properties, and that's to get ahead of any potential changes in capital gains tax that might adversely impact them. Likewise, there have been a number of accelerated purchases of properties to take advantage of the stamp duty land tax exemption, which at the moment is scheduled to come to an end on the 31st of March. So you can see how tax changes which are known about accelerate activity. And in the past, that has caused significant uptake in terms of the amount of money that the government have brought in whenever they've pre-announced changes in terms of tax rates. And so we do think this is something that the government may try to do this year, to try and announce ahead some tax changes which will come in with a view to then actively encouraging people to do things which generate tax. So, Sam, if we can move on to the what can you do now slide just before I hand over to Omar. So my last slide in terms of this presentation, what can you do now? Well, plan for now. What we mean by that is you know what the rules are today, and you know that the rules will not change before the 3rd of March. And so are there activities that you can carry out before the 3rd of March? And the team today will talk through some of those activities that you could carry out. But it might be that changes are announced on the 3rd of March, but they don't apply until the 5th of April. And it's quite likely that some of the measures that will impact upon personal tax will fall into that. Or it might be there are some future tax rises, some more significant ones that might be pre-announced, or that it might be discussed that we could have a further budget later on in the year. And that you're given notice that there are some bigger changes coming. And again, what would we say? Well, the answer to that will all be plan around what is coming. So with that introduction, I'm now going to hand over to Omar, and Omar will talk through some of the key wealth management issues that we believe that people should consider at this point in time.
Hi, good morning. Great, thank you for that introduction, Alistair. Yeah, so my name is Omar Din. I'm a financial planner here at MHA Tait Walker. There are 5 key areas that we tend to focus on within the firm prior to tax year end. Obviously, this allows individuals to make the most of the reliefs and allowances available to them, and to ensure that they're utilised in the proper way prior to tax year end. As Alistair's mentioned, the caveat being that there could be some changes on the budget on the 3rd of March. In terms of the areas I will be discussing, or we will be discussing as a team, the first will be ISAs, individual savings accounts, then junior ISAs, pensions. I'll then be passing on to my colleagues in tax to discuss in more detail capital gains tax and inheritance tax. On the next slide, please. So ISAs, individual savings accounts. Question, are you making the most of this year's £20,000 allowance? Typically, ISAs can only be held in single names, and one of the big attractions to ISAs are the fact that they are not subject to income or capital gains tax. What I mean by that, any growth within an ISA, any income that you choose to take, either a regular or fixed income, whatever like that, or any withdrawals you make, technically will not be subject to any income or capital gains tax. The current ISA allowance for this tax year is 20,000, and it will remain at the same level for the next tax year. You can invest in either a cash or stocks and shares ISA, and I'll go into more detail on that. One of the downsides, you cannot carry forward any unused ISA allowances. Therefore, that old adage, if you don't use it, it's gone, you lose it. If an ISA allowance is fully used every year as a way of saving, then over the long term, as you can imagine, you can build up quite significant amounts of savings, which are essentially free of tax. One thing I'll also touch on, lifetime ISAs, so LISA or LISA, or whatever, whichever way you like to say it. They effectively came in a few years ago, and they're aimed at being an alternative to pensions, I guess, and they're to help first-time buyers to sort of help to buy ISAs are not available anymore. Effectively, you can put in a maximum of £4,000 per year. You're given a 25% bonus from the government on the anniversary of the product, so the max bonus is 1%. £1,000, sorry, so total 5,000 a year. It does form part of your ISA allowance, so if you're putting 4,000 into your LISA, then you still have 16,000 available to put into a cash or stocks and shares ISA, and again used by first-time buyers or towards retirement. On the next slide, please. So cash or stocks and shares. So within a normal ISA, you can invest in either of these, and this is typical within the LISA as well. If your view is to use your ISA savings as a medium to long-term investment, i.e. hold it for a minimum of 5 years, stocks and shares tends to be a great way to go and where people tend to go for. Why? Over the long term, stock markets tend to rise. As an asset, equities has outperformed any other asset over the long term, so it's where you're going to get the greatest sign of growth. Obviously, saver's worst enemy, inflation. So inflation is the average price of goods and services over time. Historically, interest rates on cash within cash savings have tended to be lower than inflation. So effectively, the real return, the purchasing power of the cash available has reduced over time. Cash is important. We would always stipulate that everyone should hold cash reserves for emergencies or anything else like that. But holding too much cash can effectively become a risk, any at the risk of inflation, because of the way interest rates currently are. You may have seen, if any of you invest in NS&I, National Savings and Investments, they slashed their rates last year, again, due to the pandemic. And just an idea of current rates, current Bank of England base rate, 0.1%. Inflation at the moment is about 0.6%. And typical interest rates between various different accounts, whether they're with your bank or fixed rate deals, etc., range from 0.01 to 0.05. So the rates are not that attractive at the moment. What we found through the pandemic, as Alistair mentioned, a lot of people have got more cash available, those in that situation, and they are investing a lot more and using that cash to invest, because typically the rates they're getting are just not that competitive. On the next slide, please. So following from adult ISAs, as I would call it, are junior ISAs. So are you looking to save for your children, which a lot of people are. A lot of people more and more are putting away money into ISAs or pensions, for example, for children to save tax efficiently for them. So junior ISAs, a JISA, can be a great way of doing that. The parent guardian has control of the JISA until the child reaches age 18. Again, the same tax benefits apply, free of income and capital gains tax. The current allowance for this tax year is £9,000 and it will remain so for the next tax year. And again, you could invest in cash or stocks and shares. No withdrawals are allowed until the age of 18, and at the age of 18, the child effectively takes control of the ISA, and it's for them to do it as they wish, obviously with guidance from parents, I should say. For a parent point of view, it can be a great way to start children investing, let them sort of, what we found in our experience, when the child does reach 18, they then kind of deal with us directly, and we're educating them on how to invest, working for their future. So it can be a great start of 10 that the parents have done for children. But also the added advantage for parents, it can be a way of removing money from your estate, which might be liable to inheritance tax. We'll be talking more about inheritance tax later in the presentation. On the next slide, please. There's a different savings vehicle that I just wanted to mention within the investment because it can be very topical, and obviously it's only appropriate for a certain type of investor. They are EIS and VCTs, so enterprise investment schemes and venture capital trusts. There are a lot of similarities between the two types of investments and a couple of differences, and I've just tried to highlight the main ones here. So within both of them, at day one, you can get 30% income tax relief. However, with an EIS, you can also carry that back 1 year. There are certain criteria, as in time you must hold the investment in order to take advantage of the reliefs available. So an EIS, you must hold it for a minimum of 3 years, and for VCT, it must be a minimum of 5 years. There are maximums you can put into each investment. So a venture capital trust, it is 200,000, and for an EIS, the maximum you can get relief on is 2 million. However, the caveat in there is any amount over $1 million must be for shares issued by one or more knowledge-intensive companies, KIC, a KIC. Just to give you an example what a KIC is, a KIC is a company carrying out research, development, or innovation at the time that they're issuing shares. So the EIS will assess that at the time to make sure that it is suitable. Both types of investments have 100% capital gains tax exemption on disposal if held for the term. So again, attractive there. With the EIS, it does qualify for business relief if held for 2 years. It will be outside of your estate for inheritance tax IHT. On the next slide, please. Okay, so a bit of savings are EIS, VCT and ISAs. The next area where we find we spend a lot of time pre-tax year end is within pensions. So are you getting the most from tax saving benefits from your pension? So effectively, a pension is a tax efficient way of saving for your retirement. In 2015, pension freedoms came into effect, which effectively gave you the option, greater options as to how you took your pension, how you took it out, became a lot more flexible. That obviously became a lot more attractive to people saving into retirement because they now had all these added flexibilities within them. Annual allowance, so everyone within the UK up to age 75 can get tax relief on their contributions up to 100% of their earnings. It's capped at £40,000 each year, and Laura, my colleague in tax, will be going into more detail on the annual allowance. In terms of pensions, you can contribute to them personally through your employer, so automatic enrolment came into effect 2012, where every employer has to offer a pension scheme. So I'm sure majority, whether you run businesses or are employed, will be part of the group scheme auto enrolment arrangement. Or as a shareholder director of your company, it could be a great way of taking some of the profits out and utilising pensions that way. Just as a fact, the government paid out an estimated £40 billion in tax relief last year. So that is the money, effectively a cost to the government for people putting in a pension. So a huge amount and a lot of attractions to investors for using pensions. Carry forwards, this is where the pensions are different to ISAs. So if you do not use all your allowance in 1 year, you can carry it forward for up to 3 tax years. Okay, the rule is you have to have used your full allowance for the current tax year, and if you want to pay any more than that, you can effectively go back and use unused allowances back to this tax year 2017-18. When we go to the next tax year, whatever you had in 17-18 is effectively lost, so it only goes back 3 years. And again, current deadline for contributions is the 5th of April 2021. On the next slide, please. So, as I explained, you get income tax relief on the money you put into your pension pot. It can be very attractive if you're a higher or an additional rate taxpayer, because you get normal base rate tax relief on contributions in, but then you can claim additional tax relief if you are within that category. The most common type and the most significant type is to do regular saving on a monthly basis, for example, take advantage of pound cost averaging, where you're effectively buying units at different prices throughout the term. And then most commonly is then to look at what your allowance is at the end of the tax year and apply a top up. And if need be, if it's affordable and you have the allowance, take advantage of unused allowances in the past years. It's possible the government might change allowances, so our sort of standpoint is always use them while you can if it is affordable. And again, the investment choice within pensions are vast. So typically stocks and shares, they are a long-term investment. However, individuals that run their own businesses, for example, and work out of a premises, you may be able to purchase those within a pension, and there are tax reliefs and benefits to doing that. They can be very, very flexible. And again, you can invest in different types of assets. You can also ensure that if something happens to you, the pension's not lost. So again, this is where differently pension freedoms came in. You can pass your pension to whoever you've nominated, and it is held outside of your estate. So if you are someone who will have a future inheritance tax liability because of the value of your estate, putting into pensions can be a great way of savings, but also getting money outside of your estate. So plenty of benefits there. Final point for me is on defined benefit transfers. We are finding more and more that people want to talk to us about this, and typical inquiries we're getting are to see how these fit in with the rest of their individual retirement strategy. So it is an area that we've come across, and if anyone has any questions, we'd be more than happy to answer them. Now, I believe that's the end of my slides. So what I'll do is I will pass over to my colleague, Laura Dixon in tax, who will continue. Thanks very much.
Thanks, Omar. So my name's Laura Dixon. I'm a manager in our private client department, and Omar's obviously touched on pension contributions, but I'm going to talk about the tax implications of making those contributions. As a caveat, as Alistair and Omar have said, the rules covered today are as of today and could change in the budget, but wouldn't be surprised if the pension rules did change. So if you were thinking about making a pension contribution in this tax year, it would be a sensible decision to look at making that before the 3rd of March. For each tax year, you can make pension contributions up to your UK relevant earnings. And it's important to know that relevant earnings for this purpose are typically earned income and trading income, and not necessarily investment income such as dividends. You can receive tax relief on the contributions up to your available annual allowances. And as Omar said, the current annual allowance is £40,000. So it's really important to know, especially if you're an employee, that all pension contributions made, including employer contributions, will be considered when reviewing your available allowances in the sometimes we've had high earners where they haven't been aware that the employer contributions will factor in. And so it's really important to know that it's not just what you're making, it's the employer contributions too when we look at your annual allowances in the year. So the standard annual allowance is £40,000, but if you're a high earner, this is actually reduced. So the adjusted income threshold for this purpose is £240,000. Previously it was £150,000, so it did actually increase in the current tax year. For every £2 over the adjusted income threshold, your annual allowance is restricted. The minimum cap of the annual allowance is £4,000. So if you do make pension contributions above your annual allowance, there will be a tax charge that arises, and that tax charge will be at your marginal rate of tax. So if you are a higher rate taxpayer, the tax charge will be 40% or 45% if you're an additional rate taxpayer. I've put a note on there about the current lifetime limit for the value of your pension fund, which is just over £1 million. There's a lot to go into that, and so there's too much to put into the presentation today. But there are things you can look at if you're coming close to that limit, and someone like Omar would be able to help with things like protections. So if you have got concerns about that, please contact us separately and we can look at that for you. Next slide, please, Sam. So the way pension relief works is when you put a contribution into your pension fund, you receive basic rate tax relief at 20% at source. So how that works is if you put in, for example, £32,000, it would be grossed up at source to give you that basic rate relief. So £40,000 would be put into the fund. Because that's only basic rate, if you're a higher rate or additional rate taxpayer, you can then claim the difference between that basic rate on your tax return. And how that works is it extends the rate bands that you can pay tax at the lower rates. One really important thing that I think is often overlooked is that pension planning can actually be put into place when it comes to things like the personal allowance. So the majority of UK taxpayers have a personal allowance where they can earn income up to that amount each year before paying any income tax. So the current personal allowance is £12,500. If you're a high earner and you earn over £100,000, your personal allowance is actually withdrawn, a bit like the annual allowance. It's withdrawn for every £2 that you're over, it's withdrawn by £1. So essentially, once your income hits £125,000, your personal allowance is completely withdrawn. Can I move on to the next slide, please, Sam? So the best way to show how this can actually work in practice, I put an example together. Obviously, this is a perfect example of the optimum tax savings, but if your earnings are around about the £100,000 mark, then this is something to bear in mind. So in this example, if you earn £125,000, you will no longer have a person. And you may have heard people discuss the 60% tax rate. It's not an officially recognised tax rate by HMRC, but essentially the amount between the £100,000 and £125,000, that income is essentially taxed at 60%. Because what happens there is that 25,000 is taxed at your normal rate, 40%, but then also the personal allowance is being withdrawn. And by being withdrawn, it is taken income of 12,500 that was covered by that personal allowance and put that back into tax. So essentially the difference between earning 100,000 and 125,000 is £15,000 of income tax. £5,000 of that relates to losing the personal allowance. So how you could actually make pension contributions to save that personal allowance and save your income tax. What a lot of people don't realise is when looking at the threshold for the personal allowance of £100,000, you can actually take into account pension contributions and gift aid donations. So what you can do is, in this example, you could make a net contribution of £20,000. It would be grossed up to £25,000 at source. You would retain your personal allowance and your rate bands also would be extended for those contributions. So the income tax saving would be £10,000. But for your net contribution made of £20,000, you've actually saved £10,000 of income tax. So the net cost to you is essentially £10,000, but your pension fund has grown by £25,000. So that's a really good way of showing people quite how much your pension can benefit by you saving some tax too. It's not quite as popular, but the same can apply for gift aid donations. So I have some clients who are particularly close to certain charities, and they have income around about the 100,000 mark, and they make sure that they gift to those charities. And the charity receives quite a decent amount for a much smaller amount in the hands of that client. Next slide, please, Sam. Moving on to inheritance tax. Before I talk about the things that you can do each year to limit inheritance tax, I'm just going to do a quick overview of what IHT actually is. So IHT is a tax due on chargeable lifetime gifts or on the estate of someone who has died. Everyone has a nil rate bar threshold of 325,000. So if your estate, including any gifts made in the 7 years before death, is less than that £325,000, you won't have any IHT due on that estate. Even if the estate is actually over the 325, if the excess value has actually been passed directly to a spouse or a charity, there will be no IHT due either. If you have a home that is passed on to your direct descendants, you are actually able to get an extra rate band, which is a resident rate band, and that is £175,000 for the current year. So if you've got a property that you're going to pass on to direct descendants, you could essentially have a rate band of £500,000 before IHT is due. What a lot of people don't know is that married couples can pass on unused thresholds to their surviving spouse. So you could actually have, if the first spouse passes away and passes everything to that spouse, there would be no inheritance tax due. And what that would mean is the surviving spouse could potentially have a basic threshold of £650,000, or if they've got property to pass on, £1 million. So IHT is charged at 40%. The only exception to this is if any of the estate is left to charity, then that can actually reduce to 36%. Next slide, please. So the majority of transfers during lifetime will fall into the category of potentially exempt transfers. So they would typically be like a cash gift or transfer in a property. They wouldn't immediately be chargeable at IHT, but if the transferor dies within 7 years of making that gift, then IHT would be due. 40% would apply, however, in this case, with it being a pet, it's actually tapered down depending on the length of time from the gift until death. But all other gifts that don't fall into the pet category will be immediately chargeable IHT, for example, a gift into a trust or company. There are some gifts that you can claim if you gift certain assets. So there's business property relief and agricultural property relief, and the rates are 50 and 100%. Typically, 100% relief would apply for unlisted shares in a company. There's too much to really go into in today's discussion on that, but that's just a really brief overview of the sort of assets that would receive that relief. Typically, they'd have to be held for 2 years. But what I would say is, because there's an awful lot that goes into that, if you're concerned about any assets that may or may not qualify and you want to get that checked, just contact us separately and we can help you with that. That's no problem. Next slide, please, Sam. So what can you do now each year where you don't have to pay inheritance tax on certain gifts? So gifts made out of your normal income, so regular gifts that don't affect your standard of living. So for example, you could make a birthday gift every year, that wouldn't be taxable. Gifts between spouses and civil partners. Every year, everyone has an annual exemption, which is £3,000, where you can make a gift up to that amount and not pay any IHT. If you don't utilise it in 1 year, it can carry forward to the next, but it can't go beyond that point. You can also make gifts for wedding gifts, so £1,000 a person, but this increases to £2,500 for a grandchild or £5,000 for your own child. Gifts to charity aren't taxable. Payments that can be made to help another person's living costs. These would typically be a vulnerable person, for example, an elderly relative or a young child. And then you can also make small gifts each year up to £250 a person, as long as no other exemptions are already being used on that same person. Next slide, please, Sam. The short-term planning. The first thing we would say is look at the last slide and all of the smaller gifts you can make without it affecting the IHT due. And also what might be coming up in next month's budget. Obviously no one knows, but a couple of points that may be considered is at the moment on say on the death estate, when assets are passed out for capital gains tax purposes, there's no tax due there, whether or not IHT was due on that asset being passed out on death. And what happens there is the person who receives it obtains it at the market value at that date. So if the person who owned that during their whole lifetime had made a huge gain on it, that gain is actually unrealised and there's no CGT due. But one thing that may be changing is that when an asset is then passed on death, the value would actually be rebased and you would actually obtain it at the original cost that the first person obtained it at. So you would then, if you sold it straight after receiving it, you would have capital gains tax to pay. So that's the potential. At the moment, you wouldn't. Also, if you gift into a trust at the moment, you can claim to hold over the capital gains tax. That may be changing. It's just something to be aware of if you were wanting to make some changes and transfer some assets now. although you would have to obtain proper advice, full advice on your personal circumstances, it may be something to consider making that transfer now rather than waiting until after March. So in terms of long-term planning, it would be really sensible to look at the value of your estate today and to just be to make sure you're comfortable with the potential IHT due. Also, if you've got any assets in the family that you may want to protect, so assets that on your death may be passed down to either a minor child or an older child where divorce is of a concern, you may want to make sure assets are protected in a way that you want. So a trust, for example, could be looked at. And then every year I would just recommend everyone checks assets that they think qualify for business property relief and agricultural property relief and make sure they still do. And just as an ongoing basis, check that qualifies. Obviously reliefs may change next month and that's something that would feed back if it did, but just on an annual basis, just to make sure you're comfortable that things still qualify. And that's my IHT done now, and so I'll pass on to Claire Smales.
Thanks, Laura, and morning, everyone. So I'm Claire Smales. I'm one of the senior managers in the tax department at MHA Tait Walker. So Alistair spoke earlier with regard to some potential areas the government are looking to seek to raise some taxes, and one's capital gains tax. So we're going to look at that in a little bit more detail now. So capital gains, it's quite a complex area, and generally it's payable when you sell an asset at a profit. So it can arise in a variety of assets. So we commonly see it with sort of shares or second properties, but there's also other valuable assets can be subject to capital gains, like jewellery or antiques values. That's something to keep an eye on, in an area where we often see people fall foul of the tax. So every person has an annual exemption each year, which is currently set at 12,300. So no tax will be payable on gains that are up to that limit. Any gains over that limit will then be subject to tax at the appropriate rate. So the basic rate is, if you're a basic rate taxpayer, it'll be taxed at 10%. Anything over the basic rate band will be taxed at 20%. However, if that asset is a residential property, those rates increase by 80% there. There's also a lot of reliefs and exemptions available. One of the main ones that is probably known is business asset disposal relief. So this was formerly entrepreneurs relief. So this is where certain qualifying business assets are disposed and you can benefit from a tax rate of 10% regardless of the amount. So even if you're a higher rate taxpayer, additional rate taxpayer, you'd still just pay 10% on those assets. So gains will be reported on your self-assessment tax returns, and any tax payable by the 31st of January following the end of the tax year. So if you made a gain in this last tax year, the tax won't be payable until the 31st of January 2022. However, if that disposal is of a residential property, that does need to be reported, and any capital gains tax paid within 30 days of completion. That's something to be aware of, and it's relatively new. So as previously mentioned, there's been a lot of stuff in the press recently about possible capital gains tax reform, and this is certainly an area that we're keeping an eye on. The next slide, please. So last summer it was announced that the government were going to be looking into potential capital gains tax reform and looking from the perspective of both individuals and smaller businesses. So the scope of the review was really broad and included both administration aspects but also technical points. So it was going to be looking at like tax rates, all the reliefs, exemptions, allowances that are available, as well as interaction with other taxes. So Laura's already mentioned one of the potential changes with the interaction with inheritance tax. So in November last year, one of the first of two reports were issued which outlined some of the areas that they would potentially be looking to target. Next slide, please. So one of the areas is the business asset disposal relief. So as previously mentioned, subject to certain conditions being met, you may be able to benefit from a tax rate of only 10% across an entire gain. So this is commonly what we'd see if people own shares in a company, and when they come to sell it, and they only pay 10% on that, on the gain arising on that. So one of the conditions that must be met is where you hold at least a 5% shareholding. And it has been indicated that they would look to possibly increase that minimum shareholding a suggestion of 25% has been put there. So that obviously makes a bit of a difference, especially if you just have a very small minority holding in a company. Also, at the moment, you only need to hold those shares for a period of 2 years before you can qualify for this relief. And again, they're looking to increase that holding period, and the suggestion's been about 10 years. Finally, one of the things that's been mentioned is the potential reintroduction of age limits, potentially linked with the age limits and pension freedoms. So what this does is it may mean that relief is only really available to those individuals who are looking to sort of retire from the business world, rather than ones who are selling a business venture and entering into a new one when they're potentially a little bit younger. So this actually aligns, and it's similar to a retirement relief that was phased out in the early 90s, so in the late 90s. So we're maybe going back to that sort of situation. So the other thing that's been looked at is tax rates. So currently, as you will have seen on a previous slide, there's quite a lot of different tax rates, and a lot of it depends on exemptions available and reliefs and what type of assets they are, and it can be quite complex. So one of the things that has been mentioned is looking to simplify that, and one way to do that is by aligning the rates with income tax rates. So obviously the income tax rates are generally a lot higher than capital gains tax rates. That would mean that there is additional cost when you sell an asset compared to under the current rules. This is probably easier to see if we use a couple of examples. So next slide, please. So if we look at one example based on an individual selling an asset where the proceeds are £1 million. So on the assumption that you're going to qualify for business asset disposal relief, the tax that you would pay on that would just be at 10%. So you would get net cash in your hand of 900,000. However, even if you didn't qualify for business asset disposal relief, and under the current rules, you may pay capital gains tax at 20%, assuming you're an additional rate taxpayer. So your net cash in hand would be 800,000. However, if business asset disposal relief was no longer available and they also aligned the rates to income tax, then you could potentially be paying tax of 450,000 on that same disposal, leaving us net cash in hand of 550,000. That's obviously quite a substantial reduction, which might not have been planned for. Next slide, please. So we can look at this as well in a slightly different way. If we use exactly the same example where you sell an asset for £1 million and you get net proceeds of 900,000 on the basis you qualify for business asset disposal relief, if the changes came in where that relief wasn't available to you and the rates were aligned with income tax, you would need to sell that asset over 1.6 million in order to get the same cash in your hand. Obviously, these changes, if they do come into play, they're going to make quite a big difference to what you can exit with. Next slide, please. So what sort of things can you consider doing now? So one of the things that we would always recommend to people when you're coming to the end of the tax year is looking at, have you used your annual exemption? Are there any assets? Do you have any stocks or shares that you're looking to sell? Just make sure that you're making full use of that exemption that is available to you. As it was mentioned, I think earlier in the presentation, is if you don't use it in this year, it's not the sort of thing that you can carry forward. So if you don't use it, you lose it. So have you made full use of it? Also, with regards to the potential capital gains tax reform, and as we've said, I think throughout this, we don't know for certain what's going to happen and the timing of it. What you may want to do is to see if you can do anything now while we have some certainty over the tax treatment. So if you are looking to complete any sort of disposal, is it possible to complete that prior to the 3rd of March, before the budget, or even before the end of the tax year, just where we have a little bit more certainty over the tax treatment? Also, you may not be selling something now, but you may have sold something quite recently where you have received an element of consideration where the tax point has been deferred. So one example here is if you have, say, sold shares in a company and part of your consideration was in the form of loan notes. And what you may have done is structured it in such a way so you don't pay capital gains tax at the point that you receive the loan notes, but instead would pay capital gains tax at the point that you redeem those loan notes. If that disposal was relatively recent, you may be able to make an election to get the full value of those loan notes taxed at the point of the disposal. So that would bring forward your tax, and it would need careful consideration because it would mean that you're paying tax before you've actually received the full consideration. But it may be that you can benefit from the certainty of the tax treatment now. Alternatively, if you may just want to seek to see if you can redeem some additional loan notes before the 3rd of March, just to bring that forward a bit while we know what the tax treatment is. So with any of these, we would recommend that you speak to professional advisors because it can be quite a complex area and it's not something you want to get wrong. So next slide, please. So just moving away from capital gains tax, with sort of coming to the end of the tax year, one of the things that you may need to bear in mind if you have residential property which is held through a corporate entity is whether you need to do what's referred to as an Airted return. So this will apply if the residential properties are valued in excess of 500,000, and the reporting for the tax year which is coming to an end needs to be done by the 30th of April 2021. So it's quite a quick turnaround. And at the same point as then, you will also need to pay any of the tax that's due. What we do find though in our experience is there is quite a lot of reliefs and exemptions available, which can either reduce or completely extinguish that tax that is due, but reporting would still be required. So it is something that needs to be considered carefully. So I've just noted a few of those reliefs and exemptions on that slide, although that is by no means an extensive list. Next slide, please. And finally, I just wanted to briefly mention some changes that are due to come into force from April 2021 with regards to IR35 reform or the off-payroll working rules. So these would impact on people if you operate through, say, a personal service company as an example. And it was all looking to clamp down on perceived tax avoidance by targeting contractors for companies who are in practice providing the same services as an employee of that business. So these were due to come into to be implemented in April 2020, but they were deferred on the basis that businesses had a lot to deal with at that time, because that was when we all first went into lockdown. So they were pushed back for a year, and it was very much seen as a deferral, not a cancellation, and there's no indication that there is going to be any further deferral. So businesses do need to continue to plan for the introduction of these new rules, and they're quite detailed. So we actually have a separate webinar for that later this month to go into those changes in more detail. So if it is something that you think may apply to you, or you are a business owner and you want to just have certainty over any of the sort of administration you might need to do to be compliant with this, then I would certainly recommend that you sign up for this webinar just to try and understand the detail of the changes. So with that, I'm going to hand just over to Mark Parkinson from our wealth management team.
Thanks, Claire, and thank you to Omar, Laura and yourself for a very informative presentation. Obviously, in the current climate, certainly as a firm, we've found a lot of clients over the last sort of 9 or 12 months running through the pandemic. There've really been not a lot else to do, no holidays, etc. So it's been spending a lot of time looking at their own personal situation. Obviously, we've got a budget due on the 3rd of March. So just Alice has already mentioned that we're holding another webinar on the 4th of March, where we'll just pick out sort of the key points that gets announced by the Chancellor. Sam, the next slide, I think, is really to open it up to any questions. So if anybody would like to ask a question, then we're happy to answer anything. So we'll just wait to see if anybody's got any questions.
There's nothing in the chat box at the moment, Mark. So I don't think anybody's put anything in there yet. Okay, we'll just give it 10 or 20 seconds to see if anybody comes forward. If not, if there is any personal questions that people may want to ask, then the next slide, Sam will give out contact details. So obviously we're happy to liaise with anybody that's on the webinar today. And if they've got any personal circumstances they'd like to discuss, then please contact one of us, and our details are there on the screen. There's a question just come in, just bear with me a second. It says, can a grandparent open a JISA for a grandchild?
Omar, do you want to pick that one up?
Yes, of course. Very common. Grandparents do like to save for grandchildren, so a grandparent by all means could open a junior ISA for a grandchild and contribute into it. So yeah, the answer is yes, and we'd be more than happy to help with that.
Yep, and no further questions.
Okay, thanks everybody for attending today. As I say, we have got future webinars coming up, which are, the details are published on our website, and everybody, we hope everybody has a good rest of today. Thank you.